broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I think we're going to get started here. Okay, it sounds like there's some feedback. I did a sound check. Let's hold on. There's something. It looks like a double microphone is going on. Hold on a second. Testing 1, 2, 3. What is going on? How's that? Is that better? I think. Does that sound better? Let me run another sound check here. Testing 1, 2, 3. How about this? Testing 1, 2, 3. Okay. Hopefully, I'm not sure what's causing that. I've used the same equipment many times. All right, so let's get started. As most of you know, we have I started this company in 1990 as a derivatives research firm, and since then we've developed into money managers, both as CTAs in the future side and RIAs on the stock side. Also, we do a certain amount of option education, things like this, as well as mentoring. We have a mentoring program. If you're interested in that, please contact us. So far this year, our managed accounts are positive on the year. We had a very strong March in terms of a hedge VIX SPY strategy that we used. Our newsletter recommendations are very positive. The Option Strategist newsletters had some of its best results that it's ever had. Okay, so this, still getting this feedback. What is going on here? I don't really have another microphone, I don't think. Testing 1, 2, 3. I still hear that echo. Hold on just 1 second. I'll try one other thing. Testing 1, 2, 3. Testing 1, 2, 3. Testing 1, 2, 3. Testing 1, 2, 3. All right, testing 1, 2, 3. So I switched to another microphone here. All right, let's try that. Back to share my screen. Got that. Okay, hopefully that's working. Okay. All right. So as I was saying, our newsletters have been very positive this year, and in that regard, we are offering 20% off on our daily volume alerts and daily strategist. And the daily strategist includes the option strategist newsletter, which has had some very strong results. As I said, the strongest it's ever had in its 30-year history. So, we've had several positions, which we generally keep the investments to like $1,500 or $1,000. And we've had several that have made 10 or 12,000, on put buys and things. Obviously, that's in the past, but hopefully, with the market being volatile, we'll still be able to continue to get good moves. Anyways, those are available at optionstrategist.com/MCM April or APR 20. All right, so let's talk about the market. There's four things we look at: the chart of the S&P 500, market breadth, put call ratios, and VIX volatility. So, as any of you who have heard me talk before, you know that one of my main points is oversold does not mean buy. So we've gotten many times in the last month oversold, extremely oversold, but really the buy signals have been few and far between. And oversold markets can continue to just get more oversold for quite some time. Conversely, overbought does not mean sell either, but right now we don't have anything that's overbought. That was occurring back in January or February. So here's the current chart of the S&P 500, a 2-year chart. The one line on here, that's the 200-day moving average. You can see that we blew right through the support at 2350. That was the December of 2018 low. And we came down and we bottomed right here at about 2190 on the S&P. Bounced from there. And the futures that night traded down to 2175. So somewhere in that general neighborhood of 2175 to 2190 is what we would consider support. And let's see if I think I might have lost my pointer here. There we go. So right around there, we have supported 2175 to 2190. There are four major gaps on this chart. Those are the blue circles. And obviously, I don't think we're going to fill those upside gaps anytime soon. But the downside gap down to 2300 is sort of still in play right now. If we do a retest, fill that gap, maybe hold again at those lows, we would have a better chance at actually having a bottom in the market. Now, we've rallied quite a bit off of there, and we rallied far enough to run into the 20-day moving average, which is this line right here. So oversold rallies typically rally up to about the 20-day moving average. Sometimes they go through it a little bit. Let me zoom in on that just a little bit. So this last rally rallied right up to the 20-day and then basically failed back down here again. That was yesterday's move. Today we close it 25.26, so we're right in this neighborhood right here. But there's definitely now some resistance up here near 2650 because that's where the rally failed. I thought maybe we could get through and get up here into this area, but we didn't quite get that far. It's somewhat interesting to note also that the largest 3-day percentage rally since 1931 occurred right in those 3 days there. I mean, that's not particularly encouraging. 1931 was a terrible year for the market. And in fact, we did some studies, and there were 7 rallies of 20% or more during the depression market from 29 to 33. So those big rallies like that don't really make much difference in the overall trend of things if they're coming off extremely oversold conditions. In fact, there they are right there. That's 28 to 33. This first rally here was the biggest, probably sucker rally in history. This was the crash. Market went a little bit lower a week later and then rallied 48% off that low. When it did that, historical volatility dropped from 111%, which is where it was at the day of the crash, to 8%. And, I mean, I'm sure everyone thought, everything's good to go. I mean, some of the big stocks like AT&T went to new all-time highs and everything else. And then it slowly started to fade, broke the new lows there a year later, and then that was basically it. So I don't know. It might be telling you can't trust the first rally off of this market either. I'm not really sure, but in any case, I mean that's probably the biggest sucker rally I've ever seen in my life. Anyway, so where do we stand now? Well, we broke it through a whole bunch of support levels. None of them really stopped the tide very much, and now we have some support at 2175 to 2190. So that's somewhat encouraging. The oversold rally did reach the 20-day moving average. I would have expected a bit of an overshoot. I don't know, we may still get that. I think the odds are pretty high of a retest of the lows, closing that gap at 2,300 and setting up a double bottom or a W bottom, something like that. But for right now, this chart is still bearish because all the trend lines are heading downwards, and it hasn't really made higher highs and higher lows, any of that sort of pattern. So at least for now, it's still bearish. I mean, a breakout over 2650 there, which is that little resistance area near the 20-day moving average, would be a little bit constructive, but there's still, I think, a lot of resistance above that. Now, we also calculate modified Bollinger Bands. John Bollinger, when he invented the Bollinger Bands, he had to define volatility, so he defined it as the standard deviation of daily prices, closing prices. And that sounds like a pretty good definition to me, too. But in reality, the math guys, Black-Scholes, BS here's Black-Scholes, they use a different method, and so do many of the other academics. And they use the standard deviation of daily percentage price changes. So it's a little bit different calculation. And so when we calculate Bollinger Bands using that, we get slightly different numbers. So I call them modified Bollinger Bands. The idea is we wait for the market to move outside of +4 or -4 standard deviations away from the 20-day moving average according to these bands, and then start to move back inside, and that's a signal. So we've had some pretty good signals, well, all through the history, but a few in the last year, including a sell signal mid-January this year. And now we're on a new buy signal. Actually, we're on our third buy signal. But here's how they've looked. The red letters are positive signals. So you can see, for example, it moved out. This is the +4 signal line right there. So it moved outside of there and then back in, and that was your sell signal. Then down here it came out, and now there volatility was low and the bands were tight together. Out here, first of all, we moved out and in, out and in. Every time you have a signal, then you move back outside again. That stops out the previous signal. So this signal right here was stopped out there, became a new signal here, stopped out there, and then this is the one that held. That one did not get stopped out. You see the 4 sigma band kept on going up here. That one was in effect as the market collapsed. When it hits the -4 sigma band, you take profits on the previous signal and get set up for a new one. So we had a buy signal there, it was stopped out, a buy signal there, and then a buy signal here. I can zoom in again on that. There was the original sell signal. We came outside and then back inside. I think that was like January 24th or something. Anyways, then we came below and back inside. That was a buy signal. I got stopped out here. Then, I'm sorry, here. And then we came below and inside again, just barely. That was a buy signal. I got stopped out here. Now the third one, we went below and inside. And so we're still operating off that buy signal. We have some long bull spreads based on that. And frankly, now with VIX being so high, or with the definition of volatility being so high, you can see the huge distance between the bands. So the -4 sigma band is in oblivion. It's down around 1900 or something like that. So, it's not providing any real stop out point. So that signal there is probably going to be carried to expiration. Anyways, let's move on to put call ratios. This is our most bullish indicator, well, more or less. It certainly looks like it is anyways. So we use the equity only put call ratio to predict the broad stock market. In other words, all stock options that trade. And there are many millions of those today. This indicator, put call ratios, was invented by Marty Zwy back in the 1950s. When he took volumes out of the put and call dealers' ads in Barron's. So it's a contrary indicator. If too many people are buying puts, then we want to do the opposite. We want to do something bullish. If too many people are buying calls, we want to do something bearish. So we'll define what too much means. But first, let's just talk about the ratio. Suppose at the end of the day in IBM, we sum up the volume on all the puts. Separately, we sum it up on all the calls and divide the two. That's the put call ratio. So notice that since puts are in the numerator of this fraction, heavy put buying makes the ratio go higher. But when is there going to be heavy put buying? Well, that's typically when the stock is going down. So if the stock is going down when the ratio is going higher, that's typical. So they're moving in opposite directions. Now, consider call buying. Since calls are in the denominator of the fraction, heavy call buying is going to make the ratio go down. But when you have heavy call buying, well, it's when the stock is going up. So again, moving opposite to each other. So the put call ratio and the stock price, in theory, are inverse to each other. We keep a moving average, 21 days, just in case Fibonacci has something to it. And ideally, the chart would look like this. Now, they don't all look that good, but let's just say the stock is declining here, and people are buying puts as the stock is declining. Eventually, the put buyers get satisfied, and the put call ratio forms a local maximum. So when there's a local maximum on the put call ratio chart, that's a buy signal for the underlying stock. And then the stock should take off to the upside. As it's going to the upside, people are buying calls. Remember that calls are in the denominator, so that sends the ratio lower. And eventually the ratio bottoms out with a local minimum. And local minimums on the put call ratio chart then are sell signals for the stock itself. So this is not a current chart, but this shows why we use the equity only put call ratio to predict the broad stock market. On the top is the S&P 500. On the bottom is the equity only put call ratio, and you can see they have this nice inverse symmetry most of the time, and that's what we're looking for. So here's the current chart updated through last night. And you can see that the ratio got very low in January and formed the local minimum. That's a sell signal. That was the lowest it had been since 2014, so almost 6 years. And that was a sell signal about in here. And at first it looked okay, but then the market went on to new highs. As you can see that no local maximum actually formed in the chart, just went sideways and then went off here. Now eventually, just last week, it finally rolled over like that, and that's a buy signal. Now we have computer analysis programs that look at these charts. It keeps a 21-day moving average. By our definition, that if that peak holds for 10 days, that's a buy signal. But we don't have to wait 10 days because the computer, with the sort of chess tree programming, can look forward and predict it. So the computer gave that a buy signal right on the first day out of the box, which I think was the second day of last week's rally. You can see elsewhere during the year there were not such big extremes, but again, a buy signal there was a very good one. Sell signal here worked okay. So the buy and sell signals are also marked on this chart. By the way, this reading here that we just had last week was the highest in history. Our history on these ratios only goes back to 1993. so I don't have the crash of 87 equity only put call ratio. It might have been higher, but since 93, this is the highest the put call ratio had ever gotten. And what do I mean here? Well, let's say it got up to 100 almost. 100 means that 100 puts are trading for every 100 calls. And that's a very high number for equity only for across the entire spectrum of equity only put call ratios. Now, as the advent of computers came in, we could do a more complicated calculation, and that's the dollar weighted put call ratio. So we can calculate the dollar volume of every trade, the option price times the volume. We just use closing prices because it's very expensive to do that as a real-time data set, and it wasn't giving us any better results. So we take, let's say, the option price at the end of the day, multiply it by the volume of that day, and that's the dollar volume of that option, or the estimate of the dollar volume of that option. We sum those up for all the puts, let's say again on IBM. Separately, we sum those multiplicans up for all the calls, divide the two, and now we've got the dollar weighted put call ratio. So now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. This is the current chart, and these ratio signals come in at more or less the same time. You can see here there's a local minimum in mid-January, and that one actually was not low. It was only the lowest in a couple of years. It had been lower in early 2018, and then it came up and gave the local maximum buy signal a week ago, and that was the highest it had been since the financial crisis in 2008. With other, well-timed buy and sell signals in between. So these are both on buy signals right now. Now, the little curl that's developed here, that's, a bit of a problem perhaps, because what's going to cancel out these ratios is that eventually at some point they're going to rise and start going back up again, and that would be a sell signal, of course. So is that one yet there? No. Not, at least not according to the computer analysis programs that we're using. So for now, we're still calling this a buy signal, but that little hook there is, and that again, that's only through yesterday's data. Today, with the market making that strong rally in the last hour and a half, it might have, mitigated that a little bit. But if this ratio goes up to a new high, that cancels out that buy signal right immediately. So just to summarize, we had new buy signals from these indicators last week. They're coming from extremely high levels, so that should be good. The previous sell signals in January came from extremely low levels. Obviously, they were excellent, perhaps a little bit early. And, we've got that little blip there in the last couple of days. But overall, that's bullish. Now, we also look at the total put call ratio, which takes into account all index and equity options, no futures options, but index and equity. And so we did have a buy signal last week right along with those other ones. The target for the total put call ratio buy signal is 100-point gain. Well, we got a 187-point gain in 2 days. So I'm still deciding whether, in a market this volatile, we should adjust our parameters, but I haven't had a chance to do that research. So the target for this signal was a 100-point rise. We got it. There's been 34 trades since 2003, so 17 years. It's exactly 2 per year. Of the 34, 25 have been winners, and of the 25, 22 have produced a 100-point gain. There have been 9 losers. So if we check every trade, all 34 trades, we would average a 65-point gain per trade. That signal technically is still on a buy signal, but it's fulfilled its target, so we're not using that as a new signal. And just one other put call ratio that I rarely mention is the equity only put call ratio, and it rarely rises. The CBOE equity only put call rarely rises above 1, but between March 9th and March 16th, it was above 1 on 5 out of 6 trading days. Now that's really unusual. I haven't seen that kind of action since 2008 financial crisis. So we had done a study, and the study said you're best to buy the last day that it does that. Of course, you don't know when that's going to be, so you really can't do that. But so our signal was to buy the second day that it did that, That was a bit early. That was probably like March 18th or something. So that buy signal was a bit early, but still a valid buy signal in that the CBOE equity put call ratio got to some extremes that it had never been at in over 12 years. What do we buy when we have these signals? Typically, we try to buy something with with a delta that's fairly high, so it's going to behave like the underlying. The higher the delta of the option you buy, if you're right about where the underlying is going, which is what we spend our time trying to do, is predict where the underlying is going, then your option is going to reflect well on that prediction. But if you buy some option that's too far out of the money or has too high of an implied volatility or something, then you might get the correct move in the underlying and still lose money in the option. Excuse me just one second. I'm going to grab a Coke or drink. Hold a second. Okay, sorry about that. So we typically try to buy on a short term, try to buy an option with a delta of 0.7 or maybe even 0.8. On a more intermediate term trade, like a put call ratio, we typically are buying an at the money option, which has a delta more like 0.55. The reason we buy the lower delta there is because we're going to be in it longer. So we're trying to balance the risk of paying more time value premium to be in the position, but we still want an option that's going to respond to us. Now, do we ever spread? I mean, these guys on TV spread way too much. All the option guys there, I don't know why. They maybe think it sounds more conservative on TV or something. But, if you if you say you put a bull spread on, you're bullish on the stock, you buy a call, you sell another call at a higher price, you're cutting off your profit potential. So if the options are fairly priced or cheap, that doesn't make any sense at all. You're just cutting off your profit potential for no good reason. And of course, they'll say, well, you're not risking as much money. Well, you're risking 100% in either case. So if you're worried about pure dollars, then buy fewer dollars, buy fewer outright long options than you would have on bull spreads. Okay, so when does it make sense to spread? Well, when options are expensive or implied volatility is high, and that's certainly where we are right now. So on the way down, we did some bear spreads, and it blew right through the entire bear spread. But the way to counter that is to widen the strikes out even farther. So if you're getting, like recently, we've gotten some buy signals. So we're widening the spread strikes out to like 25 or 30 points on the calls. If the market goes up and VIX comes down, your call is kind of swimming upstream. So the spread helps that. And also in any of these spreads, if you hit your short strike, you can pick the whole spread up and reset it, which we've done a few times as well. And then even though the spread might have not been the optimal position, at least it's still a viable position, and obviously it's going in the right direction for you. So just to summarize, put call ratios are all on buy signals, all three of the things that we look at, and they will remain on those buy signals unless the ratios roll over and start to go higher again. I'm just going to show you a few individual put call ratio charts. We interpret these just a bit differently. In other words, we don't count every local maximum and every local minimum on the put call chart as a signal. We only count the sell signals if they're coming in the 10th percentile or lower of the previous 600 days put call ratios. And buy signals similarly have to be in the 90th percentile or higher. So on this chart, we had a sell signal there that didn't really work. So that's marked in blue. But then it got back down to below the 10th percentile 2 times, gave us 2 sell signals. We were waiting for it to break. It broke down here and just it went back up above our breakdown level. Do we get out? No. Once we're in, we follow the put-call ratio chart. And technically, this thing is still on a sell signal. It has not peaked and rolled over. It kind of had a little wiggle there, but it hasn't really done this. So we're out. I mean, we took our profits on this, but technically, it's still on sell signal. JP Morgan, same sort of thing. A great buy signal there, and then this sell signal here came in a very, very low level, the 0th percentile, in fact. And again, we were waiting for it to break. It broke and then came on down. And similarly here, again, it has not made a local maximum to give us a buy signal. This one, however, has given us a local maximum. And sell signals on Microsoft were not working across the line here. This buy signal back there was a pretty good buy signal. Local maximum there got stock rocketed higher. But this got so low, got down to 20, meaning $20 were being spent on puts for every $100 being spent on calls. That we said, all right, we have to take this signal, and there was a little support area there at 182, so we bought the puts there. We're out of them now, and this one technically has rolled over as of yesterday. It was a little more like that, and the computer is calling that a buy signal. So we post about 650 individual put-call ratio charts into our strategy zone on our website every day. That's a very cheap subscription, about $200 a year. We also publish implied volatility charts. There's about 2,000 of those going up every day now because volatility is at such an extreme. But along with that, there's a little computer program that tells you when these things are rolling over or not. So you could look up Microsoft in there and see what the computer thought about that little hook. Is it a buy signal or not? In this case, it was. So that information is all there as well. A little more recently, we just issued a buy signal last week on FXI, the China ETF. That rolled over there. Even though this is like a small rollover, the computer was calling that a buy signal. And you can see this one back here worked out pretty well. So we're in that one. And then this one, I kind of violated one of my own rules. We have a sell signal here. You can see that. And typically what I'll do, though, is wait for support to be broken, which would be there. Instead, I went ahead and bought the bear spread, and the thing went like this. So I would say if you haven't gotten in this one yet, I would wait for it to break that line there. I think that's at about 130 on this stock. And so that would actually make a better spot to get in. All right, so let's move on to market breadth. Breadth is simply a daily, you take the daily advances minus the daily declines, and the one thing you can do is keep a cumulative total. Today, even though the Dow was up 460 points, there were only about 540 more advances than declines, so not so good in that regard. But breadth has been weird. Actually, breadth has been pretty weird all through the Trump administration. I can't explain why, but it's just a lot of rolling over and stuff, I guess. Anyways, we'll talk about the cumulative total in a minute, but we also keep an oscillator. And the oscillator is 90% of yesterday's oscillator value plus 10% of today's advances minus decline. So this is a number that kind of swings back and forth, positive to negative. And this chart right here goes back to 2013. And you can see that where I've marked it here, oversold is below minus 400 and overbought is above my plus 200. So since we've been in a huge bull market since 2013, we didn't get oversold too many times, a few times. And then here in 2018, right before Christmas, massive oversold. And then just 2 weeks ago, the most oversold in history. But again, remember, oversold does not mean buy. So you only get a buy signal when you stop being oversold, which is right there. And that was about 3 days ago. And now it's a little bit hard to see in this chart, but we've already come back down below, we're back in oversold territory as of last night. Tonight it's going to be close, whether it comes back out of there or not. But anyways, let's look at this one back here, December 2018, for just a second. It came back out. It gave us a buy signal here, so it was pretty early, in early January, and the market just took off. And you can see how overbought we got. This is the most overbought area on the chart. It's high, it's wide, and it was extremely overbought. Lots of volume, lots of advanced decline, lots of breadth. And so I'm not a long-term trader, but long-term traders were saying that was extremely positive, and it was for a year or so, a little over a year. But now we've broken down and given all those gains back. And as I said, all the way back here to December of 2016, we've given all those gains back in just a month of trading. So where do we stand on breadth? Well, we had sell signals back in February, very timely ones, and then we got buy signals last week. They were stopped out. So right now, we're in modestly oversold territory, technically on sell signals, but as I said, I haven't calculated today's numbers in there yet. I mentioned breadth had trouble expanding, and one of the things about when the market was making new highs, new all-time highs in January or February, breadth was having a real tough time staying positive. In fact, the cumulative advanced decline line on stocks only made a new high on January 16th, and then after that began to fall off, even though the stock market was going higher. So that's a negative divergence that, we noted at the time. We had other sell signals, so I wasn't jumping on this as a major indicator, but it is something to pay attention to. And just as a warning, a lot of technicians will say the cumulative advanced decline line can be a positive indicator too. It really can't. If it's making new all-time highs at the same time the market's making new all-time highs, that doesn't mean a thing, because the New York Stock Exchange advanced decline line did make a new high right along with the market in February. It's only good as a negative divergence indicator. Other than that, people that say that are, they're just wrong. I mean, you can go back in history many times. Many bear markets have started right after cumulative advanced decline lines made new all-time highs. There's not always a divergence. Anyway, that looks like I got those out of order, right? Those two were supposed to have been before the other one. All right, let's spend some minute talking about volatility. There's two things we look at in VIX. One is the trend of VIX should be opposite to the market. And then number two, spike peaks on VIX are buy signals for the market. So when VIX gets very low, like down around 12, anything below 14, I consider to be extremely low on VIX. Sometimes people say, oh, that's overbought, and you can start shorting the market. You really can't. I mean, the market can continue to go up a long time while it's overbought. No, it's overbought does not mean so. You have to wait till VIX begins to rise. So here's your VIX chart going back about a year, and you can see, VIX is staying down here at very low levels, well below, a couple of probes towards 17, but mostly it was down around 12, 13, 14. These were spike peaks up and back on the VIX chart, and so we have a trading system built around this. So these red signals were successful buy signals. This one was not, because it was a little bit early. If you recall, last May, the market went down for most of the month, and VIX never followed suit. Anyways, we got this sell signal right here, though, on February 20th, and that's when the 20-day moving average of VIX, which is this one, broke above the 200-day, which is this one, and VIX was also above itself. Now, you can go back in here, maybe you find a day or two where that happened, like maybe there, but pretty soon VIX went back below and canceled out any negativity at that point. But this one took off. So we had two stopped out buy signals. Again, I said the system has rules, and now we're on another VIX spike peak buy signal there. The market's not any higher than it was then, but VIX is certainly lower. So I was opining today in one of the daily volume alerts newsletter that perhaps at these high levels, rather than buying calls on the stock market, we should be buying puts on VIX when we get those signals. Down in here, buying puts on VIX wouldn't have made any money to speak of. Buying calls on SPY did, but up here, obviously buying puts on VIX would have. And you can't trade VIX, but you can trade VIX futures. And the options on VIX are actually options on the futures as well. So anyways, that signal is passive on the, let me go back and talk about the trend. So just recently, we've slipped below the 20-day moving average. So VIX closed below there, and then today VIX closed at 51, so about right here. a VIX at 51 is still dangerous. I mean, it means the market can be all over the place, and it was today. I mean, way up, came all the way down, gave back all the gains on the oil news, and then rallied in the last half an hour to go to new highs on the day. So that kind of action, I find, uh, makes me nervous, but it's just what's going to be the case when VIX is up in the 50s. So I'd say here the trend of VIX is still higher. Maybe when the 20-day moving average rolls over, starts to decline, we might want to abate that a little bit. But we did a volatility study, and I just published it this last Sunday, and went out to all of our paid subscribers. So, and if you sign up for a new subscription now, you'll get that study. But we looked at volatility levels in past market crashes. We looked at what implied volatility did and historic volatility. I did a pretty in-depth analysis of 1928 to 1933 with implied volatility. And so a lot of those things are pretty interesting. But right now, and I'm going to show you a chart near the end here, historic volatility, actual volatility is way, way above implied, which is very strange. And of course, that's not a situation where you're necessarily going to be selling options. Now, a lot of people are selling options now because VIX is so high, but I think you need to be careful because with realized volatility being so high, things can change quickly. But if VIX falls back into, let's say, the 40s, and then realized volatility will probably come down, you can see, into the 30s, and then you can still get very good premiums for selling options, and you won't have that worry right now that realized volatility is greater than implied volatility. Anyways, a couple of times we've had overlapping buy signals from this indicator. We just trade the first one, so we got that first one there marked with a green B. There were a couple of others after that. The 200-day moving average is still well below the 20-day, and that's what gave us that sell signal back in February. I mean, it's going to be a long time before that reverses itself, I think. So overall, the intermediate term picture here is still bearish or volatile anyways, whereas the short term signal does have that buy signal. That buy signal, by the way, lasts for about one trading month, so it's still good for another couple of weeks. Now, what I call the futures construct, the VIX futures construct, is where we look at the price of the VIX futures and see how they compare to VIX, and B, how they compare to each other. So most of the time, you'll have like the April futures here, the May futures here, June here, July here, and that's the term structure, and it slopes upwards. And then VIX is up here somewhere. That's what normally happens. So normally the futures are VIX is, I'm sorry, VIX is down here. Wrote that wrong. So VIX would be down here. So the futures are trading at a premium to VIX, and the term structure slopes upward. That would be bullish. But it's opposite right now, and it's very bearish. When the term structure inverts, and I'm going to show you the examples in a minute, but right now April is here, May is here, and June is even steeper down here. So it's a very negative sign for the stock market. This was when it goes from this construct up on top here to this construct on the bottom. That is a huge sell signal for the market. That happened on February 24th this year. So it was an excellent time to go short and also go into the VIX SPY strategy that I had mentioned previously. Here's I took these pictures, the snapshot this afternoon. So VIX at the time was trading at 52.88. The April futures were trading at 48.09. So 48.09 minus the price of VIX is minus 477. So those futures are trading at $4.77 discount to VIX. And you can see the May futures were $5 and whatever change lower. So that's trading at a $10 discount to VIX. Then the next one was 4 lower, then 3, then 2, 2. So this term structure is definitely sloping downward. And as a result, these longer term futures are trading at monstrous discounts to VIX. Now, what's interesting is that this discount basically has to go away by expiration. The VIX and the futures will come to the same price on expiration day. Now, due to the quirky way it's calculated, they don't necessarily get to the exact penny same price, but let's say they get within 50 cents of each other, something like that. So there's a lot of profit potential there. If you could, let's say, buy this future and sell VIX, you can't sell VIX. You could try to capture this differential. So the VIX buy hedge strategy that we use does attempt to capture that differential. That's how we made a lot of money in March. Anyway, by the way, those futures, if you just go to the CBOE website, I believe even the regular CBOE website, but certainly the CBOE Futures Exchange, cfe.coe.com, and you'll see all the futures prices there on the front page of the website. They're probably delayed quotes, but at least you can see them. But these indices are published by the CBOE all the time. They transmit all during the day, starting at 3:30 in the morning till 4:30 Eastern or 4:15 Eastern in the afternoon. They publish a 9-day volatility index, VIX, which is a 30-day, a 3-month, a 6-month, and a 1-year. These also prices were taken this afternoon, and you can see they slope straight downwards as well. Again, a downward sloping term structure is negative for stocks. So this is a very negative setup here, and I think it's, again, telling you there's plenty of caution in this market. So the VIX futures are trading at a deep discount. The term structure on the VIX futures is sloping downwards, and the term structure on the CBOE volatility is also downward. That's all bearish. Now, it does, though, lead to eventually there will be a buy signal. Eventually, VIX is going to close below the 3-month. And when that happens, that's a buy signal for the S&P 500. Usually just a short term, like best gains are in the first week kind of buy signal, but there will be. It's just that I don't think that's going to happen anytime real soon. There's another one like that too in the 9-day CBOE volatility index. Now it closes below at least one of the others. That will also be a buy signal. So those haven't set up yet, but we're keeping an eye on them. So just to summarize here, the SPX chart is bearish. There is that modified Bollinger Band buy signal, but the chart is bearish. It's going to have to try to make higher highs and higher lows to get out of the mess that it's in, and I guess the first progress towards that would be a close above 2650, or certainly a close above 2730. The put-call ratios are bullish. They're coming off of very high levels. The breadth oscillators are on sell signals heading into today. We had positive breadth today, so those might be in question. The trend of VIX is bearish. The 20-day moving average is still rising. VIX is very high. We do have that VIX spike peak buy signal, but as I said, that has not produced any kind of really great results so far. The term structure, that's the most bearish thing of these types of indicators that we have still right now. So right now we were looking for an oversold rally. We got it. I still think there's a chance that oversold rally does try to go to 2730. We've got a lot on that, but we also maintain a core bearish position. And there's two things in here that are really making the core bearish position for me. This, the chart of SPX is still bearish, and this, the term structure is bearish. You don't have any kind of long-term bull market starting out of until the SPX chart improves and the term structure flattens and starts to go positive again. Now, I mentioned earlier that we had done this volatility study, and here's the current volatility. The pink line is the historic volatility of the stock market. Now, this is the Dow because that's what I had the long-term prices on going back to 1928. So you can see here in the crash of 29, the volatility got to this level, which would come over to the right-hand side. It's about 120 means 120%. So I got up to like 116% at its high. The crash of 87 got up to about that same level. This one so far has gotten to 106. So right now, at least as of last night, the 20-day historical volatility of the Dow and of the S&P, by the way, it was 106%. That's, it's an annualized number. It's just, you don't worry about what the number means. It's just way bigger than normal. Normal is like 20 or something. But it's higher than VIX. It's twice the price of VIX. So that's why I'm saying realized volatility is much, much higher than implied volatility right now. And that's also somewhat of a dangerous sign. You can see the only other really high one on the chart here is 2008, but it didn't get as high as those other ones. And there's some other ones along the way that happened, and they all had certain things going for them. But it's sort of interesting. Coming out of the Great Depression, there was another spike up in volatility and a market collapse because the Fed raised interest rates in 1937, and that caused the economy to lurch backwards again. And that's when they invented the word recession. Before that, they just had depressions and booms, I guess. I don't know. And then the only other time after that it got above the 44% historical volatility was when the British evacuated at Dunkirk, and it looked like Germany was going to win World War II. You can see from then forward, it never got that high again until the crash of '87. Since then, it's been that high several times. So we're just in a different kind of market these days. Anyways, I did mention that there is a better approach, a hedged approach, where we try to capture that discount on the VIX. We call it the VIX SPY call hedge. We did a paid webinar on this last weekend. We're offering the recording of that paid webinar on our website for $69. I mean, our subscribers who did these in the option strategists were making like $10,000 on this trade or more. So $69 pretty cheap for that. And as I mentioned, if you go to this area of our website, optionstrategist.com/MCMAPR20, you'll get 20% off. I'm sorry, 30% off on all the daily volume alert subscriptions. This expires a week from today. Daily volume alert, we have all these signals that I talked about here. Plus, we follow takeovers too. So we had Tiffany, the Medco, Axe. And right now we're trying to build a portfolio up of kind of deals that we expect to go through, but they've been hurt because the ARBs had to sell the stocks down below the, widen out the deal, the spread in the deal. Also, we're offering 30% off in the daily strategist, which comes out twice a day and has a market report in the morning, a volatility report in the afternoon, and it also includes the option strategist newsletter itself. So all of that combined in this one newsletter. Same website, MCM, April 30% off. Also, we have a series of Saturday webinars that are paid as there will be 14 of them in total. We've done about 6 so far, but they're all recorded. So if you sign up now for the remaining ones, you get the previous recordings as well. And we have a YouTube channel where I post market comment every Monday morning before the market opens. So I invite you to become a subscriber there too. So that's it. This is our website address for these things. Let me just see if we have some questions here. Undock this thing. Okay, we do. We have a bunch of questions. Probably most of them having to do with the sound. Yeah, okay. Yeah. Yes, it was recorded. I'm sorry, I should have said that. So you'll get the recording of this as well as the PDF. You'll get a link to the recording and the PDF tomorrow in the email, maybe even tonight. So can you explain why gaps have to be filled? For me, I don't really know the exact reason, but they normally are. This chart right now has, like, as I said, those huge gaps on the upside there. It's going to be a long time before they are filled. And every time you say gaps have to be filled, somebody will go back on a chart and say, well, here was a gap at, 146 on the S&P 35 years ago. It's never filled. I mean, it's just something that seems to happen more often than that. That's all I can say. We've had little hard news until unemployment numbers. I'm sorry. And no quarterly earnings, withdrawal of guidance, no new guidance. Seems we've been trading more in panic, but the seriousness of the news and implying the market can reach 1800 or less on SPY. Do you believe this type of level is realistic as earnings and guidance come out? Okay, so I don't believe that earnings and guidance have anything to do with anything, but you can feel free to believe that if you want. I work off the charts. Uh, those things are sort of in the rearview mirror, but to me, the evidence is that every time earnings come out, the stock gaps and goes some other crazy direction. If they were all that meaningful, wouldn't that have been built in the first place? Anyway, forget that. So technically on the chart, yeah, I could see perhaps testing, the early 2016 lows, which are quite a ways down there because we had a pretty good year in 2016. But you're talking SPX. Let me just tell you where that level is. So yeah, 1810. Yeah, I agree with you. 1810, 1800, something like that is definitely a target for this market. I don't necessarily say it's right now because we're so oversold, and you saw like in the depression, you had this big rally and then you went down and took out the lows. But considering the extent of the damage, I could see 1800 as a possibility eventually. So who's buying the market to make it go up on bounces? Traders, smart money, institutions. Probably all. I mean, the institutions tell you they didn't do a lot of selling on the way down. I don't believe them for a minute. But somebody did a lot of selling on the way down. It certainly wasn't small people, because I did see a statistic today that there's a surprisingly large percentage of portfolios at Fidelity or something like that that have not changed anything since they were a month ago. They're like the small guys, and they're just like, oh my gosh, I just wrote the thing down. Um, so I think the market is a lot of traders, the high frequency traders are making a ton in this, but they don't stay in a position long enough to make 100-point rally in the afternoon or something like that. That's more like swing traders. But yeah, there's a lot of traders in here right now, and you never know what the hedge funds are doing. What's the minimum time do you buy for call options? Well, we typically in our recommendations here, our signals are at least a week. So probably 2 weeks is the least amount of time I'd ever, in our recommendations that we do that. Here's someone who bought the VIX SPY trade last week and has been losing money. Yeah, I mean, we've had trouble on those this week too. So it's a catch-22, right? I put out the seminar and the first trade loses money. I always used to say, you want to know what a drawdown is on a fund, buy the fund, and then you'll find out. So yes, we are looking to move back into the VIX SPY a little bit closer to April expiration. The April expiration for the futures is the 15th. So probably starting middle of next week, we'll start reestablishing the VIX SPY trades in a larger size to capture that discount, assuming it's still there. Which volatility input does Black-Scholes use, daily or annual? So, well, you're free to use whatever you want, but I think typically, like the 20-day historical is something that usually works pretty well for Black-Scholes. Can you describe what the SPY VIX class covers? Well, we spent a lot of time describing how to trade VIX, what the futures are, what the options are, how the options are based on the futures as their underlying, what the discount means, how the discount goes away, and then eventually how to hedge trying to capture the discount, which creates the strategy. So we take it from ground zero. You don't have to know anything about VIX futures or anything if you're going to want to look at that seminar. So, like I said, a chart of stock like Disney is bullish and VIX is bullish. I didn't say Disney was bullish. That's still a sell signal there from the put call ratio. VIX is bullish. I mean, VIX is elevated. The trend of VIX is higher, and put call is, well, the put call ratios are bullish. I'm not exactly sure on that whole question, but you might want to send me summary of it in the email. How do you recommend positioning for earnings season? Well, we had a lot of earnings-based strategies that are all pretty much out the window right now. One of our most successful ones was to buy buy straddles on stocks that were going to report earnings, because typically the earnings are so unknown to the analysts that the stocks are making these huge gaps. But now the options are all too expensive to use that. So right now we're not using any earnings-based strategies at all. But we will, again, when they get back into the normal range. Can you explain the logic of the inverted term structure being bearish for stocks? I can, but it takes a while. In the seminar on VIX SPY, we do talk about that. Just think of it this way. So near-term volatility is very high. We know that. We see the market flying around. Long-term volatility is 3 years from now. We don't know where it is. Probably it'll be back to normal in the low 20s or something. So just to connect the dots between a high short-term volatility now and a longer-term low volatility, that's how the term structure slopes inversely. But when it slopes inversely, that means there's a huge demand for protection, and usually for good reason. And so that sets up strategies that hurt the stock market. I mean, that's as deep as I can get into it right now. Can you put call analysis be used for day trading, or is it better? I think it's better for intermediate term swing trading. Can we use put credits instead of calls for the VIX SPY trade? Yes, you can use. I mean, you can always use a credit spread or something. But again, you cut your profits off. So like this last time we set this up, and back in 2008 we did them too. That's why we kind of invented the strategy. I made a lot of money, and if you'd have had spreads on instead of just outrights, you would have left a lot of money on the table. So I don't really like it that way. There are many S&P futures that trade, and so maybe that might be a better approach. I can see IV declining fast. Is it a good time to open butterflies? Well, I'm just telling you right now that the traders of butterflies and condors have been all carried out on structures. I mean, maybe now is a better time to get in. Certainly it's not a good time to be in there before. There was a big fund called the Harvest Fund that had billions of dollars in assets, and their strategy was overlaying condors and the S&P on bond portfolios. And in 2018, in that last December drop, they got blown out and lost everything. The fund went out of business. Same thing happened this time around with some others. So those strategies are very, very nasty. I'd be very careful with those. But if you're right, if implied volatility drops, they could work. Just make sure. I would say just use a high implied volatility or a high volatility estimate, and make sure your short strikes are at least 2 standard deviations away. How did you define oversold? Well, I showed you on the breadth indicator that that was oversold. Put call ratios at like all-time highs, that's oversold. The SPX chart, actually we have something there too. I didn't talk about it, but it's the number of standard deviations away from the 20-day or the 200-day moving average. So when you go below -4 sigma on the modified Bollinger Band, that's oversold too. So there's oversold conditions in all of those. We have specific ones for the total put call ratio, for example, etc. Says that URL isn't working. I'm pretty sure we tested that this afternoon. I did something there. Hold on. Let me just test it right here. I can do that. All right. Ugh. All right, I'll get that fixed in just a couple of minutes. Okay. The coupon code is supposed to be, what did I say? April 20th. I'll check on that too. Hold on. You shouldn't need the coupon code. If the link works, it should go right through, but I'll get that fixed up. So, in fact, let me just text somebody right this second that I'm on this. Okay. With the inverted volatility curves, can you do a calendar spread? Yes, you can. In the futures, you can buy the May, say, and sell the April. The problem is when you do with the options on VIX SPY, if the market moves one way a lot, you just have a limited loss on one side. If you do with futures, just say buy the May futures, sell the April futures, and they converge, you make money at $1,000 a point. But if they diverge, you lose money at $1,000 a point. So during the crisis or a couple of weeks ago, that spread was almost out to minus 17 or something. So that's a lot of risk, but it can be done. And as I said, you can trade. You can trade a mini future too. Can the volatility and put call ratio analysis be used to determine whether retail or institutions are dominating? I have never been able to determine that, so I'm going to say no, but at least not the way I do. I've been able to do it. For short put options, 1 month, buy longer term put options. Oh, that was the calendar spread. We'd have to talk about that. Shoot me an email. We can discuss it more. What's the signal on CSX? I don't know right now, but you'd have to go. As I said, if you go to our website in the strategy zone and sign up there, you can see put call charts on 650 stocks. Is it worth buying calls on the oversold rally when VIX implied volatility gets crushed every time the market moves up? So there's a theory that when the market, I'm sorry, it's a different thing. When the market goes down and VIX goes down, you should buy straddles. That's a theory I've heard of. Well, when the market goes up and VIX goes down, that's like what's supposed to happen. I don't know if you have any continuation on that necessarily or not. Where do you obtain put call ratios on individual stocks? Is there a good source? Yeah, it's right here on our strategy zone. We post 650 put call ratio charts every day. So there's a set of about 250 that we guarantee to publish, all the big ones. Then any stock whose options are averaging 7,500 contracts a day, that one is also published. And then, so it all adds up to about 650 right now. How about volatility skew? Do they still work or do you recommend them? I'm not sure what that one means exactly. Did the Black-Scholes model itself use annualized volatility? Well, these are all annualized volatilities. Any volatility is annualized, so a 20-day historical volatility means you take the price pattern of the last 20 days and annualize it. So typically any volatility that I'm talking about anyways is an annualized volatility. All right, I'm going to sign off now. I'm going to get that link fixed right immediately here, and then hold on, they're texting me. Let me just stay with this right now. I got a text from one of my guys. All right. All right. Well, I'll get it fixed within the next few minutes. All right. Well, thanks for attending. And as I said, you'll get the recording of this and a link to the recording in the PDF either tonight or tomorrow. Have a great day. Have a great day trading tomorrow.